So, imagine this. It's 2026. A hypothetical war with Iran has kicked off, and the world's financial markets are in an absolute freefall. But here's the thing. It's not just that things are bad. It's that the crisis is breaking every single rule we thought we knew.
You know, for half a century, there was a pretty simple playbook for a geopolitical crisis. You sell stocks, you buy bonds, and you buy gold. It worked like a charm through every major conflict in the Middle East. But this time, that playbook has been completely torn in half.
And this is the central mystery we're going to solve together today. In a crisis, some things are supposed to go up while others go down. I mean, that's diversification 101, right? But right now, almost everything is falling all at the same time. So what on earth is going on here? Let's dig in.
Okay, first things first. Let's really establish just how broken that old playbook is. We're in completely uncharted territory, and all the old maps are proving to be totally useless.
So on the left here, you see the classic flight to safety. Money moves out of risky stocks and rushes into the perceived safety of government bonds and gold. But on the right, well, that's our bizarre new reality. There is no flight to safety. It's more like a sell-everything panic. So you have to ask, where is all this chaos coming from? Well, if you follow the trail, it leads right back to one place, the global oil market. And it is in an absolute state of panic.
This one number really says it all. Oil prices have surged by more than 40% just this year, rocketing from around $60 a barrel to over $90. And this isn't just a little price spike. It's the single fastest, most aggressive rally we've seen since all the way back in 1983.
The market is in a state of what traders call extreme backwardation. Now, in simple terms, that just means traders are willing to pay a massive premium for oil right now because they're terrified it won't be available at all in a few months. This isn't some guess about the future. The market is screaming about a shortage that is happening today.
So, why can't OPEC and its allies just pump more oil to calm everybody down? Well, it's kind of a moot point. With the Strait of Hormuz, which is basically the exit ramp for 20% of the world's oil, totally blocked, any extra oil they pump is effectively landlocked. It simply can't get to the global market.
And it's not just oil. A parallel shock is absolutely hammering the natural gas market. Qatar, which supplies a staggering 20% of the entire world's liquefied natural gas, has stopped all its exports. The result? European gas prices have just exploded, soaring 80% and threatening to bring back the very energy crisis they thought they had just escaped. Okay, so now we can connect this massive energy shock back to what's happening in other markets. This is where we solve that central puzzle of why all the traditional safe havens have completely failed. This table right here, this is the scene of the crime. Just look at this. Stocks are down, okay, no surprise there. But government bonds are down too. Remember, when bond prices fall, their yields, the interest they pay, go up. And incredibly, even gold is down. The only real winners are oil and the US dollar. There is simply nowhere for investors to hide. And this slide explains what we can call the gold paradox. See, normally a crisis sends bond yields down, which makes gold, an asset that pays you nothing, look a lot more attractive. But today the oil shock is driving massive fears of inflation. So investors are selling bonds, which pushes yields up. All of a sudden, holding an asset that pays you zero income is a terrible bet. And that's the key. The market is treating this as a massive inflation shock, not a typical financial crisis. Now, if we zoom out, you can see this creates a nearly impossible dilemma for the global economy and its central banks. They are caught in a classic, textbook stagflation trap. The bond market is sending the single most important signal right now. Yields on the 10-year U.S. Treasury have jumped from 3.93% to 4.13%. That is the market's clear, unambiguous verdict. The biggest fear here isn't a recession that kills demand. It's runaway inflation that destroys the value of money. And this is the trap. It is a total no-win situation. The oil shock pushes inflation up while at the same time pushing economic growth down. So what do? If you raise interest rates to fight inflation, you risk a deep, painful recession. But if you cut interest rates to protect growth, you let inflation run completely wild. There is no easy answer. Every single move is a painful trade-off. Well, the market has already delivered its verdict on this impossible choice. The odds of a U.S. recession happening in 2026 have nearly doubled, jumping from just 18% to 33% since the conflict began. The risk is now very, very real. You know, what this crisis is really showing us is something much deeper than just a temporary disruption. It's exposed these profound, long-term shifts in the global financial system. We are facing a new financial reality.
And this leaves us with 3 new realities we have to contend with. First, the old crisis playbook is useless against a supply shock that causes inflation. Second, the idea that we can always count on reliable oil supply is just not a guarantee anymore. And third, stagflation, that ugly mix of high inflation and low growth, is no longer some fringe tail risk. It's now a very realistic base case.
This isn't just a story about markets. It's about a fundamental rewiring of the entire global economy. The old assumptions, the old playbooks, they're gone. And that leaves us with one critical question. Is your strategy ready for the new reality?